we are going to have a discussion about how to get liquidity from your VC fund GPs. I think Dan has a super fascinating background, which in my opinion makes him very, very qualified and special to teach us about this. So I'd love you to share your background and the roles you had and the places you had them, and then,
Okay, sure. So nice to see everyone. Thanks for joining our group here. So my background originally started in finance. I wanted to be a mutual fund manager. This is coming out of high school and college. So I worked at Smith Barney, Merrill Lynch, Fidelity with the fund managers in Boston, Sanford Bernstein. Spent most of my college years working actually in finance and going to college. But then I got the dot-com thing happened, and I got struck with that bug and decided to become an entrepreneur, and over time a software kind of serial entrepreneur. So after I started a couple companies coming out of college, I later transitioned to business in Santa Barbara in around 2001 called Go to My PC, which is for remotely accessing your computer, before smartphones, so you could work from home. And that morphed into Go to Meetings. It was a very helpful product for people, and we marketed the heck out of it. We became the fourth largest advertiser after, I think, Netflix, X1 wireless camera, and maybe Video Professor. So we did a lot of advertising and marketing, and people heard about it. But Go to Meeting actually ended up being a bigger business. So that became a $600 million SaaS business that we sold for about $2 billion, first to Citrix and then to Login. So I was part of that, led the customer acquisition, and then I moved on to a company called Picasa. Anybody use that or heard of that? Picasa is digital photo software for kind of organizing your pictures, and we sold it to Google. So if you use Google Photos, that's our technology. So then I was at Google. They put me in charge of all their customer acquisition for the main products, AdWords and AdSense. So I did a lot of marketing for them. And then I worked on my own product again called FastSpring, which is, we all know, Stripe. It's like a smaller version of Stripe, like a $100 million revenue business that I built from scratch for $30,000, and 3 co-founders. Became number 13 fast-growing company in North America for about a 5-year period. So it took a while to get going, but eventually we figured it out and became really successful. So I've been building these subscription-based software businesses for a long time. And now we spend our time trying to find companies somewhat similar to the ones that I was part of building. After doing that, I was angel investor for some time, had good success doing that. Joined a couple VC funds, kind of like a venture partner, learned the business. And then in 2020, launched Santa Barbara Venture Partners.
So amazing. And when we were prepping yesterday, he was telling me all about the firm, and then I asked about his background. I said, wait a minute, it's your background that actually makes you unique to do this. As an investor, this is something I feel strongly about. Every time I see opportunity, a market niche, a special, strategy or whatever it is, that's great. But if you give me 5 different teams who are showing me that same exact thing, I want to know, why is your team the appropriate team to do this? So I think that the fact that he's worn all these different hats and sat in all the different seats, and I really like that he worked at venture firms as a venture partner to kind of learn the business before he said, I can start doing the business. I appreciate that aspect as well. So tell us a little bit about Santa Barbara Venture Partners.
So what Santa Barbara Venture Partners does is it invests in software companies that are generally doing recurring revenue subscription services, like what I did in the past, that are beyond product market fit. So they already have a few $1 million of revenue, and they've been around long enough that you can see all their customers have gone through at least one cycle of saying, I want to continue or I want to churn and stop. So you can kind of see that predictability of their future revenue stream. And we're growing 2, 3, 4x a year. So super fast growing, later stage recurring revenue software businesses that don't lose customers. Businesses that are really hard to mess up relative to pretty much any other kind of business. So that's what we do, and we help these companies with something that's the most important thing to them other than survival. It's something they can't get help from other VCs, which is marketing. So my marketing background, Dan's as well, and the rest of our staff, but more so, we have over 100 limited partners, and we specifically recruited chief marketing officers, VPs of marketing, directors of marketing and sales. So we've got dozens and dozens of folks that are able to come in from day one and help the companies grow faster by helping them pretty much any facet with acquiring customers, which I bring to Google, and marketing in general, from branding to trade shows to search marketing. Any of those areas we can cover with the investors that we have, and it's just something other VCs can't help.
So the thing that struck me when we were prepping for this is that, as investors, we always see financial models. We see pretty pitch decks, and there's always this hockey stick growth. And then you're like, how are you going to sell that thing? How are you going to acquire customers? And what I loved about what Dan has built is that your firm, that is all you do. So the type of capital you invest is attached to the answer for how to acquire customers and grow your business. So I thought that was really interesting.
How would you describe your unique value proposition with respect to distribution, if that's the key?
So with respect to
distribution, I mean, basically you said marketing and sales, so it's obviously able to attract investors.
So we're helping the companies grow their revenue faster. What happens is these are relatively early stage companies with say $5 or $10 million of revenue. Their marketing team's like 2 or 3 people, and those 2 or 3 people need to do marketing in say 50 different areas, right? They're running ads on TV, they're doing organic search, they're doing trade shows, they're generating content. But they only have, say, decades of experience in a few of those things. So we fill in all the gaps because we've got a person who's done nothing but trade shows for the last 20 years and a person that's done nothing but content for the past 20 years. And we've got that across 25 different or more areas of customer acquisition and marketing. And then we bring those resources to our company and we make connections and say, hey, this person, you're looking to do email marketing to your users, you're not extracting enough revenue there. Talk to the person who's done that for Live Nation for the past 20 years, and they'll help you.
Do you include influencers at all in the?
Yeah, we have one person that we work with who did the influencer campaign for Paramount Plus when they did their launch, and they did it for Coca-Cola. They were part of an agency, kind of pioneered some piece of influencer marketing. So yeah, that's one of the many areas that we cover in those 25 plus. But really, it's any ways to acquire the customers. That's what we're good at.
I want you to clarify for us, what is the exact relationship with all these experts? Are they LPs? Are they people who are in your Rolodex?
So,
yeah. And let me explain why I think this is important. Because what I think you're doing is you're transitioning the traditional venture model of operating partners, right? Operating partners are specifically, within the venture fund. And then you also have, in addition to operating partners, you have venture partners, right? But you're expanding all of that out a little bit more, correct?
Yeah.
And so tell us, what is that structure? So we understand if they're an actual LP in your fund, of course you can call them and leverage their expertise. But are you also calling out other people in your network?
So about 75% of the people we have helping our companies are LPs in the fund.
Okay.
But when we find someone, so for example, we worked for a while with the ex-CTO of Salesforce. And for whatever reasons, he didn't want to invest in the fund, but he loves helping startups. So he's like, I'll work with your companies, but I'm not going to invest right now. He ended up investing. Now he's investing. But for a year and a half or so, and so we're like, okay, well, that's awesome. You're the ex-CTO of Salesforce the last 20 years. You're willing to help our companies. So we started introducing him to our companies. And a few of them decided, rather than just getting some advice here and there, they wanted to take it to the next level. They made him an advisor, and they gave him a little bit of stock. And let me answer a piece of his question that I missed.
Yeah.
So our LPs have the option to help our portfolio companies. We don't pay them to do that. They're equity owners through the fund, and it's voluntary. So each time we have, let's say the example of trade shows. So our trade show person, we say, hey, we've got this portfolio company. They're looking to expand in trade shows, and they're not doing that great. They need to figure out which shows they haven't done and how to look better at their shows and presentation. Would you like to talk to them? And that person will say, I'm too busy, or yes, I'm interested, yes, I have the time. Okay, then we make a connection. Whatever gets worked out between them gets worked out. Maybe they get some advice for 40 minutes every 6 months, and maybe they end up hiring that person to actually help them as a consultant to do the trade show, which is good for us because then we know the right person is helping them grow on trade shows, right? It's really case by case determined between the LP or the advisor and the portfolio company. If they work something out, great.
So
We're not in the middle of it, but remember, it's all optional. So someone can be an LP and never know. They don't have to help. It's all optional. So if you want to give some free advice, great. If you don't, no problem. And we have quite a bench because we have over 100 LPs. So something like trade shows, that person's busy or not interested, we've got another person. So it might not be as good, but they'll still have similar experience.
So I'm going to just give some commentary thoughts on this because I think that this is going to be the future model. I'm going to explain why. Because at the end of the day, it's their relationships that are giving them the first phone call when a great investment opportunity happens. Everybody talks about deal flow, call it the deal flow, but the real issue is how do I get in the deal that 50,000 other people are trying to get in? And to me, it seems like what you've done is always answered the phone call, provided the free help, provided the free advice, and not trying to monetize and transact each time. And it's very serendipitous. So you asked how I ended up here. They just asked me to fireside chat, but I very much have a similar business model, and that's why my phone rings first, because they know I'm going to make 20 phone calls to help them just because it's the right thing to do. You're not going to actually monetize all of it. And I think this is how our entire industry is going to start shifting, where the old model was very transactional. You had to be able to attach a revenue stream or economics to every action, and now there's going to be actions that allow the sum of the whole to become greater than its parts, even though you cannot directly connect all the different actions. So there are probably sometimes you make referrals and whatever you it never monetizes, and then other times you end up with the ex-CTO of Salesforce on an advisory board of something you're invested in, which helps your investment be super more successful. So I think it's a very forward-thinking way of approaching it.
We think the traditional way doesn't make sense.
Do you report any metrics?
Well, so we have a really recent example of the value add showing up in actual results. We just invested in a data company maybe 4 months ago out of LA. And this company sells data that they collect from emerging markets like Africa, India, Brazil, places like that. And as investors, one of the things we noticed is their product's better than the competition's, which is like Nielsen, but they're charging 10% of what the competition's charging. So as marketers, we looked at that and said, wait a minute, I myself have done a lot of successful price experimentation. So we had to convince these guys to try that. You never know, maybe it won't work. But a lot of founders don't do a great job maximizing price. They're just afraid of charging what maybe the market's willing to, they won't even test it out. That's just how it is as entrepreneurs, what I've seen in my career. So we brought in a couple of our LPs who have done a lot of price experimenting to tell these guys what could result and how to do it. And we convinced them to test it. Well, it hasn't been very long, but instead of charging 10%, they went to some of those same customers and new ones that they're talking to, and they're saying, actually now the pricing is 10x. They're testing out 10x the pricing. And what those companies are coming back and doing is they're not saying, oh, okay, yeah, we'll do that. They're kind of beating them half. And so the value, the revenue per client is now 4 or 5x, effectively overnight, because of the marketing guidance that we've given the company. Now that's a special situation. We don't accomplish that degree of revenue increase every time, but that's our most recent example of where this help really makes a difference to the value of our investment.
Okay, so tell us about, I want you to talk to us as if we don't understand investing, because I've heard the term liquidity thrown around a lot.
Yeah.
What exactly does that mean? How do you define it? And how does your firm strategy help provide what you term continuous liquidity? What does that actually mean?
So we have this strategy working toward that's pretty different from other funds, where we believe a venture firm can be the type of asset class that produces ongoing continuous liquidity as it goes, as opposed to when there happens to be a big event or at the end of a 10-year period, which involves a lot of hope and good fortune. And we're delivering on that. I think liquidity, I would look at as cash for cash returns. How much did you put in? How much did you get out? How does that compare? How long does it take? What are the returns you get? I think it's as simple as that. But it's cash-based, coming back to limited partnership, provided cash-based.
And so talk a little bit about the timing, because usually, that's kind of what the issue is. If it's a successful investment, but you get your money.
Well, so to give you a sense of how our strategy is playing out, so those of us who are invested in VC funds, like I am as well, typically within the first 5 to 7 years, there's not even a single exit or anything that really happens, right? And that's normal. The portfolio is still baking. But in our case, in contrast, we've had 6 exits in our first 5 years. And some of them are exits like an acquisition, which you really didn't have that much control over. Others are ones we engineered that are partial exits. So we believe in shaving some of our holdings as they increase significantly in value, because we don't know necessarily that they're going to maintain that growth. They're going to maintain, say, their AI multiples indefinitely, right? So instead, when we see a 3x or a 4x, rather than hold 100% like most VC funds will do, shave off 10%, maybe the next round, even higher pricing, we'll shave off another 10%. We still own most of the business. And these are businesses growing 150, 250% a year. So if we shave off 10%, lock in the profit, send it back to our LPs, give them that validation and that return will be guaranteed. That company's growing so fast, it really doesn't take very long to recapture 10 or 15% of value. It's kind of growing 10, 20% a month in that stage. So it's like, you wait a couple months, like, yeah, we kind of got our value back. Meanwhile, we're pleasing everybody who's invested in us, giving that return, locking that 3x or that 4x. So,
can you just speak a little more about the 30% you have reserved for follow-ons? Because it seems like your strategy is trying to create liquidity on follow-ons. More.
Sometimes it depends.
It depends on the price.
Case by case evaluation.
So what's been your history of actually putting money to work in follow-ons versus taking liquidity?
Well, let's see. We just did a follow-on in our existing open fund, but not open to investment, but we're still making investments in it, which is fun too. So in that case, we had invested $2 million, and we just did a follow-on for $750K.
What type of price difference?
Actually, significant price difference.
So you're averaging down or averaging up?
Well, the first time we paid a valuation of 70, and not that far after we paid 130, which is a significant difference. But the revenue changed from 10 to 18 and a half in this period of time.
Yeah.
Fortunately, we invested most of the money at the 10.
Yeah.
So we're doing well. This is all within about 5 months. So we said, we're going to regret it if we don't buy more of this business. It looks more expensive right now, but actually the rate is growing and what's going on. And we can kind of see this is the one where we increased the revenue so much overnight.
Right. But in other examples, when you have that type of increase, you're looking to take liquidity.
Yeah. If we invest in a company and then, it's valued at 2.5x, 12 months later, for sure, we're looking at both sides. Should we buy more or should we sell into it? Should we sell 10%, 15%, right? So it's very much the case. If it's 5x, we would. Maybe if we would.
Return it back to your LPs, everything. That's the new model. You're going to see that it's going to be very hard to.
Maybe we don't go far enough. Maybe we'll learn over time. We should have gone further.
And it's great. You're going to very few people.
Question from my side. So how much time do you spend on finding these exit opportunities, right? Because it takes time, right? So you can either invest or find how to exit. So what percentage of time do you need for
It
this?
takes some time. I don't think it's highly distracting. SPVs, they can be a little emotional. You got to raise all the money again. It takes, I don't know, maybe 10% of our time when we're working on it. But we think the whole mindset should change, right? There's all these VC fund committees. There should be an exit committee that meets once a month, evaluating, are there opportunities for exits in this portfolio or the last fund or the last fund? That's how I think firms should be thinking about this all-important thing to LPs, their customers, right? So that's kind of how we look at it. Is this an ongoing questioning of our portfolio in terms of buying more or selling more? and what opportunities are there to do it. And we have found that if you do want that liquidity and you work hard enough at it, you can find those opportunities. Now, obviously, if a company's not performing well, it gets more and more difficult. But we've done it. We've had 6 transactions in this time.
Dan, who else is adopting this model?
I don't know. When the Wall Street Journal did their story, they're like, who are these guys in Santa Barbara producing and engineering these exits when nobody seems to be able to get liquidity? And they said, they're like, why isn't everybody doing this? I said, I don't know. Ask them.
So, yeah.
Not just your team has a lot of expertise in marketing and customer acquisition, which is what you're providing to your portfolio companies. But is this because that is your expertise, or do you find that your portfolio companies are lacking in this aspect more than anything else?
It's a good question. I would say first and foremost, this happens to be our expertise. I would say that some of our companies use a lot of our help. Like they'll talk to 30 of our investors and advisors. And then we have the other extreme too, where they want to have us as their investor to like put us on a shelf, but they don't actually use us. So they think they're going to want the marketing help, they want it for their future, but then they're like, don't call us, we'll call you if we need help. And we accept whatever, we don't want to annoy people. But I think the way that comes into play is also a lot of our leads come from other VCs who want us to help their portfolio companies because they can't do this help and they want their companies to grow faster, right? So like our second fund, the majority of our leads came from other bigger VCs writing bigger checks saying, could you take a look at this company? We think they could use more help in customer acquisition. I mean, who couldn't? They're all trying to acquire more customers, right? So it ends up being kind of a way that we get fed so many great deals that are already in the portfolios of other VCs who are saying they could send it to anybody, but if they send it to Santa Barbara Venture Partners, they're going to get the marketing help, they're going to get help with revenue growth acceleration. So something we do we haven't talked about. Because we have this value add that's so unique, a lot of times we come into companies between rounds because they're so desperate to get our marketing help that normal VC is like, hey, are you raising money? No, we're not raising money. That's it. They move on and follow up. With us, we open the door right back up and say, oh, but you want our marketing help? Well, what if we bought some of your shares, Mr. CEO, or some shareholder you don't want anymore or who wants to get out? So a decent percentage of the time, we have the regulatory ability to do this. We buy the shares, and that's what we did when we bought that 750,000 additional shares. There was no round. The company doesn't need any more cash. So we worked and worked to try to find a way to get more stock. And eventually we got the 2 co-founders to take that 750K. Now, does that ruin their motivation? Well, it's 2 co-founders having 750K, splitting it post-tax. No, we don't feel like that's a big problem. But that's something that we do is we get very creative when we're looking for stock. And we're able to open that door back up when other VCs are like, okay, let us know when you're raising again. We think that's the start of the conversation at the end.
So your first fund was what vintage year, and how are you doing on the DPI?
I'm sorry.
Your first fund was what vintage year?
2020.
And how are you doing on DPI?
We've returned about 20 cents on the dollar. And the reason that it's there not higher is because we're selling very small pieces, right? 10 to 15%. Thank you. Yeah. I mean, we're ranked, in the Cambridge Analytics and whatnot. Our second fund's already top 10%. Our first fund's 25%, although we have a deal that we're going to show, and that will reflect probably put us in the top of it as well there. So that the part of the reason it's at that is because we sell these small pieces. The other one is like we sold a company to GoFundMe. They bought our company called Classy 9 months after we invested for 2x what we invested, but it was an all-stock transaction. So, and then when we sold Jackpocket for $750 million last year to DraftKings, the largest acquisition DraftKings done, that was partly stock as well, but also we were a later stage investor, so we didn't get the same. But what's interesting is like we could return our second fund already with if you look at the amount we've already invested. If when we're selling 10%, we decided to sell entirely each of the round, we'd return the whole fund, at least the part that we've invested in. We don't want to do that because we don't think that's in all of our collective best interests. But if it was all about giving money back, we could do that and say, hey, fund 3, let's raise a bazillion because we already returned the fund in 2 years. But we don't think that's the best idea.
And tell us a little bit about, so this, you closed your second fund.
Yeah.
So your first fund was Habit.
First
Tell us
fund
the
was-
whole metrics and economics.
Yeah.
It was
So
some stats.
we manage about 65 million right now. Our first fund was 11, our second fund 25, and then we do a lot of SPVs. The SPVs are the same companies in our portfolios.
Okay. As a potential investor, do I have to invest in your fund to get access to your SPVs?
Generally, yes.
Generally, are
Yeah,
there
if you come with a
exceptions?
$5 million check into an SPV, after our existing LPs have a chance to look at it, we would certainly look at their $5 million check.
Are the SPV terms the same as the fund terms, or is it different?
If you're in the fund, then you don't pay management fees on an SPV that is the same company, but you're kind of already paying those fees for us to be part of it.
But are you charging 20% on the SPVs
Yeah.
as well?
And are you currently raising now?
No.
Why are you here?
Q1.
Just kidding.
Relationships take time.
No. I asked yesterday. And it's true. I think your answer was super smart. He was like, I want to build relationships and I want to get to know people before I raise. And I'm like, bravo. Thank you all for being very engaged and thank you for sharing
Totally.
information.
Yeah.